All right. I just want to welcome everyone to our first ever YouTube Live. I'm David Nicholas, portfolio manager of GIAX. We're joined by Jay Pestrichelli, also co-portfolio manager of GIAX. Jay, great to have you here today.
So glad to be here for the first one.
This
is great.
Nothing like a memorable first YouTube
You gotta
Live,
have the first one memorable.
We are rocking and rolling. I'm looking at our production team. Everything sound good. We are rocking and rolling. Good to go. Awesome. Well, I joked about this earlier. We were going to have this really big, beautiful XFUNDS logo up, and last minute it wasn't working. So we have a great photo of George Washington crossing the Delaware, which I thought might have been fitting, right?
Yeah, I think it's appropriate, right?
Yeah,
like I think our funds are revolutionary. Yeah. I think we're breaking new ground here.
It really is. I think it's one of the first, and we scan the landscape, but to have a global equity allocation with a covered call, really a spread income generating piece of the portfolio was somewhat unique. So I want to talk a little bit about that as well. But as we dive in, maybe let's talk about the structure, Jay.
Yeah, sure. So the thing that is really unique here is not necessarily the global portfolio, but I think that's great what we've built. It's the option income that is generated as the overlay. So when we say overlay, what's that mean? It means we are taking the base portfolio and then selling options to generate income for our structure on a weekly basis. We're selling option premium, taking that and then distributing that in the form of a dividend once a month. And so that income that we're getting from the options market is what I think is the most unique piece of this. Yeah. And it's not just a covered call, right? There have been covered call funds out there. I don't know if there's many even international covered calls, but this is not even just a covered call. This is what we call a covered call spread, right? Where essentially we're not capping all the upside. We're still giving ourselves the ability to grow. What happens a lot of times with a covered call strategy, we all learn this in Options 101, covered calls, you get paid a premium, but you give up some of the upside. In this structure, we do not give up all of the upside, right? There's a partial. So it's really, I mean, we're very excited to be implementing a product like this on the marketplace where you're generating this income, you're not fully capping the upside, and then you turn around, you can give it a distribution, which is targeting 2% a month.
So the current, we've now done 2 40-cent dividends, about a 24% distribution for the fund. So if you think about that, a lot of at our retail firm, at our private wealth firm, a lot of investors that are retirees, what do they need? They need income. And so what's been interesting about this is, I always say you don't have to choose between growth or income. One of our taglines, and don't choose between growth or income, have both. Meaning, and the spread function allows that upside. So obviously we're selling a call, buying a call above it. Can you walk me through? I know every trade can be a little bit different, but generally, what does that spread look like generally? So, we're currently selling on the Russell.
Yes.
But we can maybe walk through an example. Russell's up 3% of the week. What does that mean for the fund?
Yeah. So the structure, we could select really any index that we like. It could be on the S&P, it could be the NASDAQ, it could be the Russell. We could even pick some international indexes if we wanted to. We like the Russell because it's got the most volatility. The options guys would say it's got the most juice in it right now, right? And so what we're doing is we're putting on a spread that is, kind of close to the market and then about 1% above the market, right? That's the range of where the spread is. And for that 1%, we're making about 0.5%, right? So all we're doing in that scenario, if the Russell's up 3%, that spread will really only prevent us from realizing 0.5% of all of that growth. So we're not, and look, in that scenario, yes, the spread ends up being, it loses 1%, but we made 0.5% when we sold it. That's what then gets distributed each week, right? That's where the 2%, per month comes from. So when you look at those spreads, it's not really that restrictive at all, right? We keep them fairly tight. We have a very defined target that we're shooting for when it comes to that, 2% a month, 24% target for the year. And makes it very simple for people to understand, hey, what should I expect when it comes to the income component of this fund? We like to make it really, really simple and easy, and that's that's the build.
That's great. And again, we'll see what happens after the elections, but it's interesting how small caps they've kind of lagged in the last month or two. So since we started the fund, I feel like we picked the right index to sell our spreads against, because in a perfect world, right, you would have the Russell that could stay flat. And even if it goes up, that's fine. We still appreciate it. But it's the other underlying holdings that if those appreciate, right, no guarantee, but if those do appreciate, you are getting some growth on those other underlying, and you're still getting the income from the Russell spread.
That's a really great point, because if the Russell stayed flat, still going to make that 0.5% a week of income from
That's right.
selling those options. The NASDAQ, the S&P, even the international components can run
Yep.
and not even feel the drag
Yep.
of what that call spread is designed to, which may prevent us from earning. So yeah, you're right. That has been the right index to choose here. It's had the most volatility, which means it's got the most uncertainty on. That means it can, it may not outperform the others. It also could go the other way too. It could spike faster.
That's right.
So that works the other side of it. If the Russell shoots up and everything else is flat, we're still going to distribute that 0.5% because we made that in the put. But we then, the fund may, show a little lagging on the upside in that scenario.
That's right. That's right.
It goes both ways. So far, though, it's it's worked out well with the Russell being the spread we're selling.
Yeah. And we'll talk about the diversification component of it. A lot of great funds you manage as well. We've seen a lot of popularity of income funds. What somewhat makes this a little bit unique, I would say, is the diversification piece of it. Meaning, it's not just one underlying that we're generating income against. You've got the one that we are, but then you've got the other piece, and it's not just U.S. based. So I think our current structure is somewhere around 65-35%, meaning that about 30-35% versus internationals.
Yep.
And again, we all know the environment that we're in with yields coming down. That potentially will put pressure on the dollar. I've been bullish on international. We saw it with China, and we can talk about that. We intentionally have not invested in China, but we see what's happening in China. But I think as the dollar comes down, potentially, that should bode well for internationals. And I think when you think about it as a retail investor, if you're working with a financial advisor, how do you allocate between global equities, right? Do you just focus on the Max 7? What about mid cap, small caps? Do you try to look internationally? This is nice because now you've got professional management where you can get some global exposure, still lean U.S. equity, and then generate income on top of it.
Yeah, I mean, the portfolio today itself even holds individual stocks, right? We hold the 7 of the Mag 7, right? We deliberately put that in there because we want to capture the driver of U.S. growth, but then individual international holdings as well.
Yep.
I don't think that the international exposure is going to be the drag on this portfolio. It could be, but look, the trade of the last 2 decades has been by U.S., right?
Yep.
But there's a very good chance that is rotating here, right? You talk about what's happening in the fixed income markets. You talk about what's happening in the currency markets. You watch what happens with the dollar here. This positions you to participate in growth outside of the U.S. while still earning a fairly healthy distribution rate.
Yep, that's right.
Yeah.
And we put allocations to Argentina. We've got exposure to India in the portfolio. Two areas that I think I'm very excited for. Obviously, we saw, if you've kept up with the race in Argentina with the current prime minister there, there's some free market reforms coming to Argentina. So I had a few people on Twitter or on X message me about they were excited about the Argentina exposure. Like we said, we got India. Look, I've intentionally stayed away from China. You could say that was from an pure investment standpoint, probably not a great move. But for us, we are believers in the free market. We're believers in not heavy government ownership, especially when you're dealing with a government like the Communist Party of China. But I think there's a way, and we've been exploring ways that we can own some Chinese companies that are potentially that don't have as much government ownership as well. So we're exploring that. But I think, again, when you look at just the breakdown of the fund, you're able to see that you do have a global exposure, but this is still a U.S. majority fund.
Yeah, like you still have exposure through Tesla, Apple, right? Like some of that have sales in China, right? So while we stayed away from a China-based company like maybe an Alibaba, right? You still have some growth you're going to experience when China does well, because the global economy will.
That's exactly right.
So we haven't completely, isolated ourselves from that in the portfolio.
Yeah, that's exactly right. So let's talk about just a little bit. And I was doing some math here on my phone. I'm going to pull it up. So portfolio construction. So if you are someone that is approaching retirement, or you're in retirement, or you're just an investor that's looking for income, or maybe you're a financial advisor that you're saying, hey, where does this fit in the portfolio? And so, there's been a lot of research done on the safe withdrawal rate, right? As financial advisors, we know that number has historically been around 4%. When interest rates went down, there was a lot of talk that number, had to increase because we just couldn't get the yields.
It was hard to maintain it.
It's hard to maintain.
And that's the intention, is to have, it's the eye of GIAX, right? We want to have that income component associated with that. And right, that smaller allocation carries so much more weight with the overall yield. So when we say 6%, that's 6% of the whole portfolio.
Right, exactly.
If you had 3/4 cash, 1/4 in GIX, let's say you're not getting paid anything on that cash, you're still going to have that 6% distribution rate.
That's a good point. From a risk adjusted standpoint, it does allow you potentially to deleverage the portfolio a little bit. If you were having to go out and risk, 89% of your portfolio to try to generate yield, you can really maximize your income producing potential by having allocation to a fund like GIX. So I think that's interesting as you think through a diversified way to generate income. And I think that's the challenge in today's environment as yields are coming down. So you have fixed income yields coming down. You have volatility. We talked about the VIX earlier. It's a strange environment for the market. Market's hitting all-time highs. Yet we have the VIX up over 20
Yeah,
recently.
yesterday was 20.
Yeah.
Sure.
Yeah. So if you're an income investor, it's like I want to participate in markets. I want to generate income, but I also, if preserving or not eroding the value of the portfolio is a goal of yours, I think a fund that sells calls but also is buying the calls, you have the call spread, really is a way that I think you can help maximize the total return for the portfolio, but also generate a nice income as well.
Yeah, I mean, you like to say this all the time, have it both ways, right? Take the income, but also have the growth together. Like this is why it's, I'm going to point to the revolutionary again. Right? This is why the fund can serve as such a utility for multiple aspects within a portfolio, because now this planned distribution from the option selling is regular, right? It's happening every week. That trade goes on regardless of what's happening in the market. It's not a market time thing. It's just for selling option premium. You know what I love about option premium, and I say this all the time, and it's an old one for you to hear, is you can earn from the natural passing of time, right? There's in options this concept called time decay. Options decay over time as they approach zero time to expiration, and most advisors that have taken a test understand this concept. But you get the benefit of the passage of time when you're selling premium, right? And so there's only one thing I can guarantee in this life is tomorrow comes after today, and this kind of a strategy will benefit from that exact dynamic, selling options on a regular basis and earning that time premium.
That's right.
But you're not capping the upside. This is, yes, you're going to give up some. Like you're not going to fully participate in 100%. It could be the Russell could do better. You could get it all. Russell could do worse. But the point is, this income is regular and it's going to be, piped into the portfolio through options. And then there's the growth aspect.
That's right. That's right. Yeah. So we talked about the income, the growth, downside for the fund. So again, it's still an all equity fund. So we would anticipate in a normal market correction, the underlying positions more than likely would correct along with the market, but you've got a cushion with the income, right? So does the income almost in some ways act as a hedge to the downside?
Yeah, I mean, in a way, we're talking about you're going to not participate in 0.5% a week, right? Do that math over 52 weeks, right? There's your 24-ish% that you're going to earn, 25, right? That you're going to earn in that, from those call spreads being profitable, right? They expire profitable. Sell a call spread for $1, it's worth $0 at the end of it. You just made that dollar, right? And that happens every single week in the Russell. It could be a different index. We may change at that time.
That's right.
So you're right. The risk of the fund absolutely is still equity risk. I would agree with that. But now there's this option offset in flat years or sideways years or even down years. It's gonna actually act as you said as an offset, as a buffer. It's really more of a shock absorber, right? It's going to lower that impact that you're going to see day to day in a declining market.
No, that's a good point. That's a good point. So I think when we think about where we want to sell the options positions on, obviously we're looking at the Russell now. What would be the catalyst to switch that index? Are you really just looking at the pricing of the volatility of the underlying? I mean, what's the real driver for you guys as traders?
Yeah, so the question, I'm going to say it another way. Are we making a fundamental decision that the Russell is going to be weaker than the S&P or the NASDAQ, right?
Tactical.
A little. It's mostly the options market that defines this for us, right? We go where there's more volatility, where it's easier to get that risk reward ratio I just called out to you. Like, hey, risk 1%, make half a percent, like that kind of a thing, or risk half, make half. That kind of ratio we like when it comes to selling options, especially at the money options. And so we're going to let the options market really define that for us. And that's usually driven by the volatility. That's an interesting concept. We could probably do a whole hour on volatility, right? So let's not do that right now.
Yeah.
When you're ready for your second one of these, I'm back.
That's awesome.
But I do think you let the options market define it. We actually scan across multiple indexes. Just so far, the Russell has been the best one to look at. It's a liquid market too. We like that, right? It's important to look at the liquidity of the options, get good fills, right? All of those kinds of things. The trading aspect of it all, flows into the decision on which index to pick.
Yeah, no, that makes sense. And if there's any questions that come in, our awesome production team can let us know. But I did have a question. I had an advisor text me before we knew that we were doing this together, and he really wanted to ask, like, and ideally, if he's looking across his client landscape, having to allocate, what type of client would this be for? Is this for your aggressive-minded client? Is this more for your conservative client? Like, again, simple question, but he's just like, hey, like, where do I allocate this thing?
What's the profile of this kind of a product? First off, not conservative because of the equity risk, right? I definitely would put it in that moderate aggressive kind of category, but it's also got that income component to this, right? So I would even take that income component and call it an alternative, right? It's not yield from corporate profits. It's not yield from interest. It's distributions from a source of trading, option trading. So that falls into the alternative category. So this would be for that stock type risk investor who's looking for alternative income as an additive to the portfolio. That's not everybody. Not everybody thinks about alternatives, right? Alternatives can be anything, right? If it's not cash, it's not bonds, it's not stocks, it's an alternative, right? It could be oil, it could be gold. All of those things are considered alternatives. But when it comes to this fund, option income as an alternative source of income, I think that's the category I put this in. So, if you really made me throw it into a range of 1 to 5, it's a 4 on the risk scale, 5 being the riskiest. But from an alternative income perspective, I would say it's also fairly high as far as the growth aspirations. I don't know how many funds these days folks are using that have this 24% target distribution.
Absolutely.
That's fairly high.
Yeah, absolutely. Another question asked about talk about the chart with the dividends, which this is a question that I get a lot as well. The dividends are not included in the chart. So
no.
So there's a total return. If you're looking at a total return chart, it will show the chart with dividends reinvested. But if you pull up a chart of GIAX, you're going to see just the NAV of the market price of the fund, not including any of the dividends.
Well, because it comes out, right? This is actually something. Sorry, George Washington. I wish we had this up here. If I could have picked anything to put up here. It's looking at total returns versus price returns. Those are very different situations. Let's say, for example, David, here's a quick math question. The fund for the year made 15%, but we distributed 24% in dividends, right? So the chart will look like we're down 9, right? 24, 15, do that math. It'll look like it's down 9. You're still up from a total return of 15%. You made, when you include the dividends, 15%. You're up, but the dividends the distributions exceeded the price appreciation of the underlying aspects, right? Whether it could be a flat year in tech or it could be a flat year in India, right? Whatever the driver is. In those scenarios, the chart may not look like it's appreciating, but ultimately you did, because total return is the way to measure it. And this is the challenge on higher distribution rate products, right? Because when you distribute the cash, the stock or the ETF will drop by the amount you distribute, right? If you're $20 today and you distribute $1, you'll be $19 with $1 of cash. You still have your $20 value.
It's not showing the same.
But if you look on a chart, it looks like you went from 20 to 19. So I think it's important to look at total return here. That ultimately is what matters to the end investor. But when you do quick research, I do this, I pull up a chart. It's the first thing I always put. Well, how did it do, during 2022? How did it during 23? How's it doing in 24? Oh, now I got to incorporate total return. Now I have to incorporate the dividends. And then when you can include that, that should change your perspective a little bit on this.
Yeah, it's a good distinction, I think, on an income fund that so much of the return is generated by the income piece of the fund. It's just important to include both when you're looking at it.
And this is not unique, right? This is, you can look at like IBM, right? You look at that stock, right? 4% distribution for year over year. If IBM only made 1% for the year, but had a 4% distribution, it'll look like it's down, even though it's still made 1%. This is just exacerbated because of the size of the distribution that we're talking about, right? So it's a perception thing. It's an optics thing. It's not a total return thing. It's not how much you're making kind of a thing either, right?
Yeah.
Which is why, you and I talk about from time to time reinvesting those dividends, if you're not going to take them out,
Yeah.
will help offset. I don't know if everybody realizes this, but when investors or when advisors make investments for their investors, it's about the size of the position in the portfolio. I don't really care. Like, I don't pick a stock. Oh, that stock's $100. I like it better than one that's 50.
Yeah.
I don't care about that.
Yeah.
I care how much is allocated to that position, right? So when you look at the portfolio, in your example that you gave before, a 25% allocation, keeping that at the 25% allocation means you probably end up reinvesting some of those dividends right back into it. Now, if you want to pull the dividends out and use them, great, fine. Just understand you're taking the profits out of that portfolio. Totally fine. We know eventually people take their money.
Yeah.
That's why we're
Yeah.
building the portfolios in the
Yeah.
first place.
Yeah.
But it's about the size of the position that matters in the portfolio. And so in order to maintain that, hey, you buy after you get paid. You reinvest dividends.
Yeah.
There's a whole program called DRIP,
Yeah.
like, right? Dividend
Automatic
reinvestment programs,
drip
right?
reinvestment.
Like
Yeah.
these, there are tools for this, because when it comes to investing, if you're going to invest in products that have yield, you should be considering a
Part
DRIP.
of it. Yeah.
Yep.
No, that makes perfect sense. Another question on the taxes, and this can get a little wonky, but return of capital. Rock had an email earlier about that. May not necessarily be a bad thing, where when the return, the fund may distribute some return of capital. So if this is a qualified IRA account, then doesn't matter. Everything in the fund, you take it out ordinary income. But in non-IRA, so just in an individual or brokerage or joint account, trust account, the dividends obviously potentially will be taxable, but because of the way the options are structured, and this is pretty common, you could be really non-taxable return of capital, correct?
Yes. So a couple concepts you just hit on there. The first one is this term return of capital. So this occurs in almost every options-based fund that I know of. And why does that happen? Let's take the example that we used before. Let's say all of our holdings are up 3%, but we sold a call spread that ended up losing 0.5% for that month, for that week.
Oh, so the underlying's up 3.
Everything's up.
Yeah, everything's
right?
up. Yeah.
Everything's up. But we didn't sell anything else that's in the portfolio, so we don't have any realized gains, right? There's no realized capital gains. The only thing that's realized is the loss of that call spread, which we'll lose if everything is up.
Yeah.
The call spread will have a net realization loss of 0.5% a week.
Yeah.
Sold it for 0.5%, lost 0.5%. Fine. We will still distribute the time value that we made on that spread. So now we've paid you a dividend, but the underlying realized gains are actually negative, right? So that gets classified as a return of capital. It's a weird way to call it. The whole fund is up in that scenario, because most likely, if we lost money on that call spread, everything else was up, right? So you have this distribution on a losing trade for that month or for that week. Well, then that gets classified as return of capital, because you didn't actually realize any gains. In those scenarios, return of capital is not taxed. You didn't actually have a realized gain for income to tax. Now that goes the other way when the call spread expires worthless successfully, and doesn't have a loss, and we still, again, always paying the time, paying the time income. Those will then get taxed as income. So you're right. You can avoid a lot of this by putting this in the IRA, in a tax deferred type account, a qualified account.
Sure.
But when it comes to return, so how will people know, right? How's somebody going to know if they had return of capital or not? That's all information that the fund is going to provide
on the website.
You're right on the website. Your 1099 at the end of the year. Probably got to wait for the first revision, right? They don't get it right the first time. But so watch those, and that's what you give to your account. You let them know. But if you want to track what's going on month by month, that's all disclosed on the website. Certainly,
that's great. Well, Jay, we appreciate you coming on for our first ever XFUNDS YouTube Live. I know we're going to be many more, so we appreciate you coming on. Excited for the fun. You can go to our website, nicholasx.com, and find out more about GIAX and all of our other funds that we have there on the site. Until next time, thanks for joining us. Jay, we'll look forward to having you back soon.
Can't wait. Thanks, David.
Awesome. Thank you. Thank you, guys.